Hello, and welcome to Business Mondays at the Urban Farmhouse. I have here with me today Mike Gracik with Keiter. Thank you so much for being here today, Mike.
Thanks for having me, Renee.
Nice to be here. It. I'm Renee Fisher with Vaco, and here today we're going to be talking about real estate and the overall Central Virginia market as it relates to the tax implications and all of Mike's clients overall. So thank you, Mike, for being here. So maybe you could start off with telling us a little bit about Keiter and what Keiter does, and specifically what you do in the real estate practice.
Well, our firm is be 35 years old this year. We're the largest local firm in the city of Richmond. We have a substantial presence in construction and real estate. At one time, before the recession, about 40% of our revenues were for construction and real estate clients.
Okay.
That has gone down a lot due to the recession, and some of those companies have gone out of business and have cut back on services, but we still have a substantial presence in the real estate and construction industries and have a lot of depth of experience with those type of clients.
Right. How are you advising your current clients that have real estate portfolios in this market?
Well, in this market, most of our clients that have real estate portfolios, the prices have been depressed since 2008 and 2009. So most clients, it hasn't paid to sell them or move them any. So they've kind of been sitting on them. And now we're starting to see evidence that prices are rebounding. There is a lot of deal activity starting to kick off in the market. So where we're working with them now is try to minimize the tax hit from the potential sale of a real estate property due to the fact that we now have substantially increased tax rates for 2013 compared to 2012.
Right. I know it's interesting, right? The market's going up and taxes are going up, so you have to be careful on the decisions that they're making, right?
Yeah, it's really, our tax system now is a real mess. It's really complicated. The combination of the fiscal cliff tax rates and the investment taxes from the investment surtaxes from the Affordable Health Care Act that kick in this year for the first time. And one thing that really caught a lot of folks by surprise, most of our clients and a little bit the folks in my industry, we thought there was a chance that the Health Care Act would be repealed. And it was not, and it's going to be with us. And there's this 3.8% surtax on net investment income, and most people thought of that as applying to your typical investment income, interest, dividends, capital gains from the sale of securities.
Right.
Well, there's some surprises with this, that it also applies to real estate. It applies to the net income from real estate. It will apply to the capital gain from the sale of real estate, so that now your capital gain on the sale of an investment piece of real estate could go from 15% to as high as 24%.
Okay.
So trying to minimize those taxes will be really important in the future years dealing with their real estate clients.
Right. So basically real estate, people that own real estate, they are going to be paying more taxes whether they keep the real estate or whether they sell the real estate in certain aspects.
There's no question about it. Unless you have proper planning and properly structure your affairs, you're going to pay a higher tax rate on your real estate operations.
Okay. No, what do you mean by proper planning? Help us a little bit with that.
Well, when the capital gain rate was 15%, tax deferred exchanges kind of went out of vogue.
Okay.
There's some mechanisms in the tax code where you can sell a piece of property and roll the proceeds into another property and defer the sale of defer the tax on the gain. When the tax rate was 15%. They kind of fell out of vogue. People were happy to pay the 15%. Now that it's 24%, these tax-free exchanges will become much more popular and come back into importance in minimizing the tax bite from the sale of a piece of real estate.
Okay, thank you. Thank you. I needed that explanation.
There's also there's a way to structure your real estate activities so that possibly the 3.8% net investment income tax may not apply to those activities. And 2013 is an important year to look at the structure of those activities, because under the regulations that came out at the end of the year related to the net investment income tax, you have a one shot in 2013 to restructure your affairs or restructure your entities so that possibly the 3.8% tax won't apply.
To set it the right way going forward in 2013.
That's right.
Well, what about the banking situation? How is that affecting your clients or potential clients when you're talking to them?
Well, it's when the recession hit, the banks kind of jumped out of the real estate market entirely, particularly in the area of acquisition and development loans. They are now coming back into the market very gradually. They will never be in the market the way they were in 2007 and 2008. The loan-to-value ratios are very restrictive. You'll probably, for an acquisition and development loan now from a bank, you're going to be lucky if you're able to get the bank to loan you 50% of the value, where in 2007, 2008, they were loaning a lot more. It puts a lot more, because of that fact, there are a lot of opportunities if you have cash to make some pretty good investment returns by helping someone bridge the gap between what the total they need to purchase and develop a piece of property compared to what the bank will lend them. So there's still a lot of opportunity out there for investors to make those type of investments, and we're working with a lot of our clients that are looking for that type of investment and yield, particularly with the a lot of uncertainty with the stock market, even though it's going crazy the last few weeks.
How do those investors find those potential clients that are looking for that bridge?
It's a lot of networking. For example, if somebody's looking for that type of bridge, we have clients that are looking to make that type of investment. We work with Markel Legal funds that are looking to make those type of investments. We have other clients that are looking for that. So if somebody, they can talk to their accountant or possibly their lawyers that may know folks that are looking for that type of investment opportunity.
Right, okay. So tell us your funniest client story ever. You don't have to do any names, no names, just
well,
funny story.
I don't know if it's the funniest, but probably the most embarrassing. I had the privilege to be Justice Powell's accountant when he was on the Supreme Court, and he was a former partner at Hunt & Williams at the time, the largest law firm in Richmond. And at the time, Hunt & Williams was known as Hunt & Williams, Gay, Powell, and Gibson. So he referred me to his former partner, Mr. Gibson, and I went to have a meeting with him in his office, and it was in tax season. I was in a hurry, and Mr. Gibson was kind of up in years. So the meeting was over, and I was trying to get out of the office to go back for another employment, and he insisted on seeing me out the door. And I thought I knew my way out the door, and I'm saying, Mr. Gibson, I can find my way out. And I proceeded to open the door and walk right into the coat closet, and he said, no, sir, that won't do.
Exactly. Well, thank you, Mike Gracik, for being here today talking about real estate and a lot of the tax implications around it with your clients and potential clients. So thank you so much for being here today. Appreciate your time.
Appreciate it. Thank you.
Thank you. Thank you to the VCU Brand Center and the Urban Farmhouse for having us here today. My name is Renee Fisher with VACO, and this is Business Mondays at the Urban Farmhouse. Thank you.